The only difference in the single family space today is that we don't do any more acquisition and renovation, is more ground up construction. And the other was more like a development firm that had an investment arm. Those were kind of like getting my feet wet into the real estate world. I think what I've learned with time has been believing in myself and my ideas and my capabilities, and understanding that the sooner you make that leap of faith, the better. In our opinion, having both helps, just making sure you kind of like balance from pros and cons of each strategy,
What lie do real estate investors often tell themselves?
believing that we have the crystal ball. There's no way to predict the future in any way.
Daniel Anghill joins me here today. You can learn what his company is up to by heading over to apexinvestments.us. That's going to be a clickable link in the show notes. Really appreciate your time here, Daniel.
Thank you, Jack, for having me. Pleasure to be here.
Well, would you mind kind of giving an overview of what Apex Investments, your specialty, and what you're working on?
Yeah, definitely. We're in the residential space. So basically, we started off only in the single family space, doing a little bit of renovation and sales, mainly all for sale initially. And later on, we got into building some portfolios in that same space. And later on, got into the multifamily world. It was back in 2020. And since then, have kept kind of like the two lanes going. The only difference in the single family space today is that we don't do any more acquisition and renovation, is more ground up construction. It goes in both ways. Some of that product is for sale, some of it is to keep in our portfolio or rent. So slowly but surely going into the BTR space, initially one unit at a time and kind of like on the scatter space. And these days starting to get more into the smaller communities and wrapping up from there. Within the multifamily space, it's been, at least up to this point, all acquisitions with usually value add approaches, given our experience in the renovation space.
Could you talk a little bit about your journey into this? I've been finding that a lot of people, it's been an accidental adventure. Was
Yeah.
this all planned?
I'm originally from Colombia, South America, and moved to the United States in 2015 with a corporate job. And, at the time I was focused in my career in that job. I had had a couple of experiences back in Colombia with a couple of one more institutional real estate fund, and the other was more like a development firm that had an investment arm. Those were kind of like getting my feet wet into the real estate world back in between 2010 and 2015. Basically, when I got to the States, it was more a finance role within company, somewhat involved in the construction world. It was a cement and ready mix company, but my role had nothing to do with real estate. During that time, I was really missing the real estate piece. And that's what kind of like brought me back to thinking about doing some of that on my own, and slowly became the transition into making it a full-time job. Later on, met my business partner and off we went to the 2018, started Apex.
What are some of the unique insights you've gained over the past 25 years?
I would say in my transition from being an employee to the entrepreneurial company building lane wasn't as easy as I thought. It was something I always had in the back of my head. I think what I've learned with time has been believing in myself and my ideas and my capabilities, and understanding that the sooner you make that leap of faith, the better. At the end of the day, there is friction. There are hurdles and bumps in the road. But on the other side, in my experience, at least, it has been a lot better. I think it's something that there's no specific trait or individual thing that I've learned. It's more like being able to build upon the different experiences throughout my career, and until that day of deciding, okay, I'm transitioning from the 9 to 5 to Apex in this case.
So let's talk a little bit about your single family homes and you're building. Some of you're selling and some you're holding as rentals.
That's correct. So Usually, how we normally structure our deals has been individual deals as syndications. So originally, we started with Renovation One. For the Renovation One was only buying distressed, renovating, and selling, and it had a single approach or a single business plan to execute. Then, when we started with rentals, it was similar, but we compiled a portfolio within one single syndication, and then similarly with the multifamily acquisitions, where each deal has had its own structure. Today, and this is something pretty recent, about a year ago, we decided to structure more of a fund where we can combine the different strategies and offer a different approach for investors where they have a fixed return, like more certainty, they have flexibility because they can come in and out a lot easier, not having to wait until the portfolio matures or I guess like the whole period ends. So that's why we have like the different types of investments, a little bit for sale, some of that is for rent, and we keep in the portfolio, making sure we keep those balances of having some kind of liquidity for those events of investors having to go out. That's the like for sale approach. And then the rental approach gives us, long-term mentality, appreciation, and also some tax benefits included there. And we combine those two benefits in one single vehicle for investors. That's the approach there.
Sure. So could you talk a little bit about, like, is what you're building to sell a different product from the one that you hold as a rental?
And the short answer is yes, from inception. So whenever an opportunity gets to our acquisitions team, there's a decision to be made. Like, is this something where we can build something for sale or for rent? It'll have different variables, demographics, the sub-market within our market, depending on where prices are, then we'll decide one or the other. The differences basically are type of home, type of specs, and price product. Usually in the for sale side, we're looking at properties between 2,000 to 3,500 square feet, anywhere starting like from the mid fives to mid eights kind of price ranges, trying to not offer a product like for a first time home buyer, especially in this kind of market where rates are high. That kind of market is a lot more sensitive to rate changes than gearing towards a market where we can have more transactionality. And on the rental side, the product is a little bit smaller, so ranging from 1,000 square feet to maybe like 1,500, 1,600, making sure that our rental rate makes sense for somebody that's willing and wanting to rent. So product does vary, and it'll depend on the opportunity.
So are you focused on a particular market?
Yes. So we're based in Atlanta, and our market has been Metro Atlanta since inception. We're staying here. We like to be close to the asset, boots to the ground, especially since most of our portfolio is scattered or like one-off. We like to be a lot more condensed just to make sure that management doesn't get out of control.
What's the benefit over like the single family versus the multifamily? Like
Right.
you've mentioned you acquire multifamily as well.
Correct. So it's interesting because there's benefits on both sides. The benefits we found on the multifamily side is just the fact that you have more units, you have scalability, some efficiencies within the site, especially if you have enough units to have like on-site management and things of that nature. When the market is flowing and all of that good stuff that we had up to maybe 2022, then everything's great. But, when things are not that great, then you're limited. I guess like your value is limited to whatever cash flow you're able to perform, and then according to whatever cap rates apply to the different markets and sub-markets, right? In the single family space, we've learned that, first of all, having flexibility of, so you need to offload some of your portfolio. You can go one at a time. You can reach out to that retail buyer, which usually doesn't necessarily have like a financial mindset for the value. So there's a lot more flexibility and exit strategies that you can apply in the single family space. Yes, it's one at a time, and usually portfolios are scattered, and there's a lot more heavy lifting on that front end. But then once your portfolio is built, we feel there's more alternatives to manage. In our opinion, having both helps, just making sure you kind of like balance from pros and cons of each strategy. We have definitely got to that conclusion of not ruling out those if you're able to manage both.
So, do you acquire properties and then try to find some sort of value add opportunity?
In the multifamily space, yes, we do. Single family today, that's what we used to do, buy distressed and renovate. Today, we're building ground up in the single family space.
Right. And then the multifamily, you're still looking for the distressed property.
Not exactly, not necessarily has to be like super distressed, but anywhere where we can find some kind of value, whether it's management related or actually physically related, whether it's amenities, exteriors, interiors, or, whatnot, as any other kind of like value approach different.
So, what are some of the common distress points that you've seen in the multifamilies?
So in our experience, it's a little bit harder to find, at least in Atlanta, since there has been through 2014 or 15 and through post COVID, there's a lot of renovation done to like older multifamilies. But, like kind of like the typical approach would be like a mid 80s kind of vintage property, which hasn't had much renovation in the interior. I would say like bread and butter is kitchens and bathrooms, just going through cabinets, countertops, and going through the bathrooms and making those better. In our opinion, those are usually like the better ways to support an actual rent growth or a rent bump. If you find a property where that has already been done, then it's usually finding other ways, whether it's on the amenity side and anything that really adds value where you can convert it into some kind of rent bump.
You're in a pretty competitive market. How do you identify these properties and structure the investment?
Yeah, definitely. Atlanta has become pretty active. A lot of competition, a lot of institutionals got to the market in the past few years. Our approach there has been like in two ways. One, trying to stay in the smaller unit count properties to avoid that huge institutional competition. And second, building as strong as we can relationships with brokers or folks that are out there finding opportunities. The off market route is usually a better route. It's just tough to achieve and to actually execute. So in our experience, it's been more a relationship networking kind of approach.
Okay. So you said kind of on the smaller side, like the number of units you're targeting.
Yeah. So we've had a couple of 100 plus units, which usually is kind of like that, on-site management mark, but we've also had less than that. So properties like 25 unit deals, 60 unit deals, 50 unit deals. Usually when you stay within that 40 to 80 unit range, we feel there's a sweeter spot to finding either owners and or managers where there's some kind of opportunities and clearer opportunities, as well as avoiding the huge sharp attack in terms of competition.
Are you still finding that a lot of the properties you're going after are still like mom and pop type outfits?
Not anymore. It was definitely the case maybe like in 2019, 2018 when we started looking, and actually our first acquisition seemed to be something like that. The typical story of somebody that had owned it for 20 years, managed himself and things of that nature. It just seems it's a little bit harder to find a little more scarce opportunities like that. But it's a matter of staying out there.
Sure. Well, I just to remind everybody, we're talking to Daniel Anghill. You can learn what his team is up to by going to apexinvestments.us. If you found some value in what we're talking about, this show only grows if you share it with another investor friend. So please consider doing that. And if you're watching us on YouTube, give us a like and subscribe. So, Daniel, could you talk a little bit about the potential to those steps somebody would take that they may be interested in what your team is doing and kind of tell us who would be a good fit?
Yeah, absolutely. I think What we have been focusing on is growing our infinity fund. That's how it's called. And it's that fixed return fund that I was mentioning. We've learned like the perfect type of individual for this would be somebody that really wants to have some 100% passive, somebody that's looking for certainty, not necessarily like huge IRR or a huge return, but somebody that wants something really reliable and flexible. When I say flexible, so for example, our lockup period is 18 months rather than, 3 year or 5 year typical kind of like hold period. So that allows people to have a little bit more option on the back end in case they need to get out, right? What we've learned is for those folks that usually are looking for, let's say, CDs, bonds, or maybe even like dividend stocks and things of that nature. In our case, there's recurring distributions, set distributions with fixed returns. So that's basically what we rely on and the type of folks that usually feel attracted to what we're doing. The best way would be reaching out and we can have more conversation about it. If there's anyone with any questions, whether because they're doing it on their own or they have any other alternatives on hand, happy to give our 2 cents and help in any way you can.
What kind of returns? You've mentioned a fixed return a couple of times here right now. What could people expect when we're talking about this? Does it depend on the investment or is it
Correct.
just
So there's some hurdles and it depends. There's some ranges on the investment. It starts at 7% for an entry investment of $25,000, which is the minimum investment, and goes all the way up to 10% for anyone investing more than $1 million. The benefit of that is there is a compounding effect for those that leave the return in the fund or reinvest in the fund. That compounding effect, with time can get to double digits easily. And that's where the benefits of staying longer come into play. So like starting off like that initial rate ranges from 7 to 10. And depending on the distribution options that they select, the ARR varies.
do you typically just work with accredited investors?
Correct. So for this vehicle, it is for accredited investors. That's a very good point.
Sure. Just wanted to make sure that I assume that was the situation, but if you, so along the way here, especially now that you're doing this type of thing, what has been the most painful lesson that you've had to go through?
Right. So I think, there's always a combination of painful and not painful lessons as you go. And it's more like as you keep learning deal by deal, property by property, we usually say in the office, there's no duplicate deal. There's always something different, right? And our experience is more, whenever you have like one investor that has gone into like one project, turned out to be not the great project, and there's like that bittersweet kind of sense whenever that happens. Fortunately enough, we haven't had drastic result, up to date. But what we have learned with feedback from investors has been more like, hey, something we even also kind of like repeat to ourselves is like IRR sometimes is a little bit too shiny, and what we're mostly focused on is on actual return rather than IRR. We've learned it is a long term play, regardless of how long you stay invested, but it usually time what ends up solving a lot of the in between situations. So that's one of the reasons why we came up with something where people can decide if they want to stay or not. We can offer a fixed return because we know where we're getting and what we're able to perform at, but encouraging people to stay in the long term. That's basically kind of like a summary of what we've learned throughout the years.
Well, you've been doing this for a while now. Are there any trends or anything that you've been seeing, or maybe you have an economic outlook of what do you think might be coming up?
Yeah, I mean, it's funny, and I laugh just because, in our position, there's always, you need to keep like what's the optimum, the baseline, and what's the pessimistic route, and try to have the crystal ball or analyze whatever information you get to try to predict and project. What we are seeing, and I think this is we're getting a lot more of this, is, we had an overbuilt over deliveries for a period of time. new starts are as low as we've had the past decade, and the correction is coming, right? We believe everybody thought it was going to be survive until 25, and we think it's more like survive through 25. Things seem to be getting better. So, for example, in Atlanta, we did have negative rent growth for a while. We're seeing that there's a correction. We did see, obviously, rates are where they are. There's a lot more potential cuts between today and the end of the year, 2025, as we speak. Looking at that, plus the absorption that we've had in the market and no more starts and just kind of like housing gap that we still have, we will have at some point the pendulum kind of like swinging back, so to speak. We do believe in that. I think it's going to be more like later in the year, probably more like first of 26 rather than sooner. That's what we're relying on and how we're building our pipeline moving forward.
So what's got you excited right now? Are you working on a big project or what's going on in your world?
Yeah, we have a few ground up constructions going on at the same time, but basically what really excites us right now is grinding on our Infinity Fund, seeing how investors are getting excited about it and making sure we keep a pipeline as solid as we can to support the thesis. That's what we're focusing on and where we're spending most of our time.
Sure. As you're growing your portfolio, have you started to bring that type of stuff in-house as well, or is it something you're outsourcing?
So that's a great question. In general, we have everything in-house except for property management at this point. One of our conclusions is property management has to be in-house, having control of what happens out there, everything related to property management, whether it's marketing, collections, leasing, customer experience. Relying on third parties, obviously starting off is a good approach, but at some point we do believe bringing that in-house is definitely a must.
Yeah. And with AI and automation and a few other things, that's one of the industries I think we're going to see some disruption.
Okay.
So before we dive into the rapid fire and close out this episode, is there anything else we should have hit on?
No, Jack, I think we've covered it. One thing that we do implement is part of our team is in Colombia. As I mentioned, I'm originally from Colombia, my business partner as well. So part of our team sits there. And it's been one of those interesting levers that we get to use because we have more headcount and I guess like manpower to take care of our portfolio. Definitely brings some efficiencies and some capabilities where once you start layering the AI on top of it, it brings a lot of benefits.
Yeah, it's pretty crazy what can be done today with a few AI agents. But this is really interesting, Danielle. I really appreciate your time. It's been great to meet you, and we'll dive into the rapid fire to close out this episode. But before we do, it was apexinvestments.us. That's going to be a clickable link in the show notes. But if you're ready, Daniel, we'll dive in and close out this episode.
Let's do it.
What lie do real estate investors often tell themselves?
Believing that we have the crystal ball. There's no way to predict the future in any way.
If you could go back in time and give your younger self a piece of advice, what would it be?
Definitely start sooner and younger.
You have a book recommendation, or what are you reading right now?
Traction.
Yep, classic. And what single process or tool have you implemented that has had the biggest time-saving impact?
Right. Actually, it's pretty recent and the traction is kind of classic. And it has to do with the book because we are implementing EOS. Initially, the concepts seem to be very plain and simple and basic, but it's interesting how those simple concepts applied and rolled out to the rest of the team makes sense. And it does come, I'm not sure if in time savings up to this point, but at least a lot more focus, definitely. It's been really helpful.
Yeah. When I was in the corporate world, there was the company I was working for, there was a lot of change going on. And I happened to be reading that book at the same time. And then I realized that they were following.
Oh, really?
Yeah, you could tell they were following it verbatim. as to what
Interesting.
was going on. So I knew what was going to happen next because I figured out that's going to happen. What was going on?
They never rolled
So,
it out as an official kind of like implementation.
no, they never announced it, but that's what that was what was definitely going on. Daniel, this was great. One last time, it is apexinvestments.us. But really appreciate your time. It was great to meet you.
Likewise, thank you so much, Jack. Appreciate it. Pleasure to meet you too, and thanks for having me once again.